we have Bret Barker, Managing Director at the Los Angeles-based TCW Group, which manages about $115 billion. And Bret is a portfolio manager there. All right, let's talk about the possibility of a downgrade. First off, will there or won't they, Bret?
Well, I mean, given that S&P has been more vocal and aggressive than the other rating agencies and has thrown out the $4 trillion hurdle rate for debt reduction, and given that the deal was only $2.1 trillion that was signed into law today, it wouldn't surprise us to see S&P act in short order. But again, I don't think S&P is telling us anything we don't already know. You know, the debt to GDP levels in the U.S. are not very consistent with other AAA countries. So again, it wouldn't surprise us to see action, and again, you saw today with Moody's confirming it, but again, giving us the warning that unless things change in the future, they will have to act.
Well, let's talk about ramifications then, because there's some debate whether or not it's going to be a big deal for the markets or not a big deal for the markets. Your take, Bret?
We think the reaction is probably rather muted. I think if you look at on a forced selling basis, risk weighting for Treasuries shouldn't change on a downgrade from AAA to AA+. Money markets shouldn't have any kind of forced selling. You could see some possible selling if margin requirements were raised and there's some kind of deleveraging that went on in the system. But again, that's not our core view. We think that, again, moving from AAA to AA+ is not that big of a deal in the sense of the markets. I think the market's very forward-looking as well. The debt ceiling passed, and we're looking beyond that right now and actually focused more on growth than in Europe at this point in time. And you can see yourself, even if there is a downgrade from AAA to AA+, Treasuries still benefit from a flight to safety haven. Trade.
Well, yeah, I mean, Treasuries have definitely been benefiting. I mean, if you take a look at the month of July, you saw gains in performance. In fact, we have made more money in July than any month so far on the year. Let me ask what TCW did. Did you go in and, I guess, bet on this game of chicken in politics in D.C.?
We did not. We never put a high probability of any kind of default happening. Our core view was something would happen at the 11th hour, which it actually did. We were not playing defensive on rates or changing or making any kind of changes to our portfolios due to this debt ceiling, I guess it's a debate or debacle, however you want to look at it.
All right, well, take a listen to what PIMCO had to say in Bill Gross.
The call on U.S. Treasuries was always that there was something better, that there was a cleaner, dirty shirt, and we've benefited, yes, from Germany and Canada. You know, we're doing quite well in terms of the total return fund. It's up about 5%. It's beating the pack in terms of performance, so we're doing fine. You know, Treasuries can do what they do, but, you know, we're in the cleaner, dirty shirt types of countries.
Okay, one point of note, I guess a few points of note from the Bill Gross soundbite there is that he calls U.S. Treasuries dirty notes or dirty shirts, as he says. Do you think there are better bets out there than U.S. Treasuries? What are you buying into?
Without a doubt, I think TCW is very defensive on Treasuries here and see a little value, especially with real rates as low as they are and nominal rates as well with a 10-year below 3%. We're seeing, you know, even our outlook is kind of a slow growth recovery, not unlike PIMCO's, but again, we can find growth in areas in the agency MBS market, which are quasi-government guaranteed. There's certain aspects of the non-agency MBS market that offer value, and even within the credit area, financials, we think money centers offer good value as well for investors.
And what about Europe right now? One more question for you, Bret, because I think we're forgetting in the mix about what's happening with Spain and Italy. Their yields hitting record highs. What do you think of this play out in Europe right now?
I agree with both Italy and Spain crossing over 6%. There's definitely some pressures in that market. I think the initial step that they've taken the past couple of weeks with the expansion of the EFSF is a definite positive. We're still very wary on that part of the market, though, and believe that we'll be having Europe in the news definitely for the next 6 to 12 months until this is finally cleared up. And in that sense, it should probably benefit Treasuries again for a small flight to quality if any kind of headline risk flares up.
All right, looking for quality. Bret, thanks for your time. Bret Barker of TCW Group joining us from Los Angeles.